First, welcome to the channel. Today we're exposing a costly mistake high-income investors make when attempting a backdoor Roth IRA, and how to correct it before penalties snowball. We'll clarify the right two-step process, break down the 6% excise tax, show you how to fix errors with Form 5329, and discuss advisor accountability. Next, let's preview what we'll cover. Next, here's our roadmap. We'll start with a quick refresher on what a backdoor Roth IRA actually requires. Then, we'll examine the 6% excise tax that hits excess contributions, including how it compounds each year the error persists. After that, we'll walk step by step through the fix, including when you may only need to remove the ineligible basis, and when earnings must also be removed. Then we'll discuss the fiduciary question and accountability options. Finally, we'll close with deadlines, a practical audit checklist, and key takeaways. Now, before we dive in, we need an important disclaimer. This content is for education only and is not individualized tax, legal, or investment advice. Rules and deadlines can vary based on your facts, and different correction options apply depending on timing. Always consult a qualified CPA, review IRS publications 590A and 590B, and the Form 5329 instructions before acting. With that clear, let's define the backdoor Roth and highlight the most common mistake. To begin, the backdoor Roth is designed for high-income investors whose incomes exceed the Roth IRA contribution limits. The correct procedure is a two-step sequence. First, make a non-deductible contribution to a traditional IRA. Second, convert those funds to a Roth IRA. You should not make a direct Roth contribution if your income is above the limit. The conversion is then reported on Form 8606 to document the basis and avoid double taxation. Now that we have the baseline, let's shift to the hidden tax trap that catches many investors: excess contributions and the 6% penalty. Next, timing is crucial. The tax year closes on December 31st, and many correction options hinge on tax return deadlines, the original filing due date, and, if applicable, the extended due date. If an excess contribution remains in the account at year-end, it can trigger an additional 6% excise tax for the next year. Some custodians and practitioners reference year-end as a practical cutoff for stopping another penalty cycle. But the IRS also ties certain corrections to the tax return due date, including extensions. Therefore, coordinate with your custodian and CPA to select the appropriate correction path for your timeline. Now let's quantify the 6% penalty and see how it compounds. Now, the penalty itself, the IRS levies a 6% excise tax on the excess contribution amount for every year it remains in your IRA. If you contributed directly to a Roth IRA while over the income limit, that contribution becomes an excess. The penalty repeats annually until corrected. For example, a $6,500 excess contribution results in a $390 penalty per year. Across 3 years, that's $170, not including the lost opportunity cost on tax-free growth. This is why early detection and correction are essential. To visualize the cost, let's lay out the math in a simple table. Next, here's a numerical snapshot. If an excess contribution of $6,500 remains uncorrected, the 6% excise tax is $390 per year. If you do nothing, the penalty recurs in year 2 and year 3, raising the cumulative penalty to $170 by the third year. This table excludes additional opportunity costs and potential tax consequences associated with distributions or conversions. With the stakes clear, let's walk through how to fix the error quickly and correctly. Meanwhile, here's a practical fix sequence. First, pause and diagnose the issue. Confirm you exceeded the Roth income limits and created an excess. Second, calculate the ineligible contribution amount, the basis. Third, contact your custodian and request a formal correction. Ask, specifically, about a return of excess contribution process and what they require. Fourth, timing is critical. If you correct by the tax filing deadline, including extensions, you may be required to remove the excess and the net income attributable. After that window, many corrections focus on removing the excess basis to stop future 6% cycles. Earnings can remain subject to normal tax rules when distributed later. Always coordinate with your CPA to choose the appropriate path. Fifth, document the correction with IRS Form 5329. That's where the excise tax is calculated and tracked. Sixth, Confirm your 1099-R and 5498 forms reflect the correction and any conversion properly. Finally, prevent repeats by executing the two-step Backdoor Roth correctly going forward and keeping meticulous records. Next, let's address an equally important question. Who's responsible when an advisor sets this up incorrectly? Next, let's compare advisor standards. Fiduciaries are legally obligated to act in your best interest and typically operate with transparent, fee-based models. They emphasize process and compliance, which aligns better with tax-sensitive workflows like the Backdoor Roth. By contrast, non-fiduciaries operate under a suitability standard and may face compensation conflicts that increase error risk. Regardless of who assists, you must double-check compliance because, ultimately, the IRS holds the taxpayer responsible. Now, if an advisor caused the error, what recourse do you have? Consequently, if your financial professional orchestrated the mistake, request written confirmation of their fiduciary status and file a formal complaint with the firm. If you're not satisfied, consider reporting through FINRA or SEC channels. Ask the firm to initiate an Errors and Omissions insurance claim to cover penalties, interest, and reasonable tax preparation costs resulting from the error. While you pursue accountability, remember the non-negotiable rule. You are ultimately responsible for tax compliance. Let's reinforce that with a quick diagram of who does what. Now, this pie chart highlights role clarity. As the investor, you are responsible for oversight and compliance, including verifying forms and maintaining records. The advisor's job is to execute the strategy properly and communicate transparently. The custodian processes instructions and issues tax documents, such as the 1099-R and 5498. Understanding these roles reduces the chance of missteps. Before we test your knowledge, let's equip you with an annual checklist you can reuse. Next, here's a reusable checklist. Confirm that your income exceeds the Roth limits before using the backdoor path. Make a non-deductible traditional IRA contribution and document the basis. Convert promptly to Roth and avoid commingling with pre-tax dollars to keep reporting clean. File Form 8606 accurately. Review 1099-R and 5498 for accuracy. If an excess occurs, coordinate the correction and file Form 5329. Finally, verify timeframes around the original and extended filing deadlines, and be mindful of year-end exposure to repeated penalties. Now, let's try a quick quiz. Now, quiz time. Which sequence correctly describes the Backdoor Roth process for high-income investors? Option A, contribute directly to a Roth and then convert to a traditional. Option B, contribute to a traditional IRA, then convert to a Roth IRA. Option C, convert to a Roth without contributing to any IRA. Option D, contribute to a traditional IRA and leave it there. You may pause the video now to consider your answer. We will discuss the answer in the next section. Next, the correct answer is B. The Backdoor Roth requires a non-deductible contribution to a traditional IRA followed by a Roth conversion. Direct Roth contributions are disallowed for high-income taxpayers and create excess contributions. Now, let's test your understanding of the penalty. Now for question 2. The 6% excise tax applies to which amount and how often? Option A, earnings only, one time. Option B, the excess contribution amount, every year it remains. Option C, the entire account balance, once per decade. Option D, the conversion amount, only in the first year. You may pause the video now to think about the answer. We will discuss the answer in the next section. Next, the correct answer is B. The 6% excise tax applies to the excess contribution amount each year it remains in the account. Correcting the excess stops the cycle. With that clarity, let's recap the most important points. Next, here are the non-negotiables. Always use the two-step backdoor sequence and file Form 8606 for conversions and basis tracking. Use Form 5329 to report and correct excess contributions. Act before key deadlines to prevent repeated 6% cycles. Hold advisors accountable and request E&O insurance involvement where appropriate. Above all, tax compliance rests with you, so verify every step and every statement. To cement timing in your mind, let's view one more diagram that maps the backdoor process end to end. Finally, This process map restates the end-to-end flow. If you're over the Roth limit, contribute non-deductible dollars to a traditional IRA, convert to Roth, and file Form 8606. If a direct Roth contribution was made in error, identify the excess, coordinate the correction with your custodian, and file Form 5329 to report and resolve penalties. Treat this as a repeatable playbook and review it annually. Now let's summarize and close out. In summary, the backdoor Roth is powerful when executed precisely. Excess contributions trigger a recurring 6% penalty, so rapid correction is essential. Use Forms 8606 and 5329 properly, and keep meticulous records. Verify whether your advisor is a fiduciary, and pursue E&O coverage if their error caused losses. Above all, own your compliance by auditing annually with a clear checklist. Now, let's wrap up with a quick thank you and a call to action. Thanks for watching. If this helped you avoid penalties or fix an issue, please like the video, share it with a friend who needs it, and subscribe for more practical, evidence-based money guidance. Drop your questions or experiences in the comments. What tripped you up and what worked? Your story could be the tip that saves someone else thousands. See you in the next one.